Welcome back to the deep dive. We've got quite a packed 24 hours of market action to get through.
Absolutely, a lot happening.
Yeah, from surprising inflation numbers here in the U.S. right up to some major geopolitical moves. So our mission today is really to give everyone a clear, structured look at the core risks and maybe opportunities in global equities, FX, and, well, the data trends.
Sounds good.
We're essentially looking at three big threads. First, the U.S. macro picture, that cooler CPI and what it means for the Fed.
Right.
Second, geopolitics. We've got high-tension trade talks, China and the U.S., plus a really unexpected spat with Canada.
Yeah, that one came out of left field.
And third, the European puzzle. Stock strength, partly an Intel echo, meeting some pretty stark FX divergence. Think Germany versus France on those PMIs.
It's a real split there.
Okay, let's unpack this. We really have to start with that delayed U.S. inflation data for September. The headlines looked like relief. What did the prepared resources actually show?
Well, yeah, relief seems justified, especially if you're the Fed. The reading was definitely cooler than analysts were expecting, pretty much across the board.
Okay, so the specifics. Headline CPI.
Headline CPI rose 0.3% month over month and 3.0% year over year, softer than consensus.
And the really crucial one, core CPI, the one stripping out food and energy that the market watches so closely.
That was also soft. It came in at just 0.2% for the month and 3.0% year over year. Again, consensus was looking for slightly hotter numbers, maybe 0.3% and 3.1%.
So what's the immediate takeaway there for the Fed, for the markets?
The core insight really is that this soft print just reinforces the market's conviction. That expectation for a Fed rate cut, which seemed pretty much locked in for next week anyway, this keeps it firmly on the table.
Okay, so this CPI number essentially bought the Fed some critical breathing room. How does this connect to their ultimate target, the PCE?
Right, exactly. It gives a strong read-through to the Fed's preferred measure, which is the core personal consumption expenditures, or core PCE. That's the one they actually target.
And the thinking is?
Well, analysts are now feeling more confident that core PCE inflation will likely peak around 3% by year-end. This CPI number just helps solidify that disinflationary path. It's really what the market needed to hear to keep its bullish mood going.
That's the good news part. But we mentioned structural tension. How worried should we be about the quality of this data going forward, with the government shutdown risks?
We should be, pretty concerned. Extremely concerned, actually. Now, this September data was mostly collected before the shutdown, really bit hard.
Right.
But data integrity is definitely the shadow hanging over future releases. The input sources are flagging specific worries about something called data substitution or imputation.
Wait, substitution, like filling in gaps with estimates?
Exactly. Instead of actual collected numbers. And this is critical stuff for making accurate decisions.
It sounds like it. How long could this be an issue?
That's the really remarkable part. The suggestion is that the integrity of economic data might be compromised all the way out until May 2026 if the collection system keeps getting hampered like this.
Wow. May 2026.
Yeah. So this isn't just, a potential hiccup in the October report. It's like a structural fog that could last 2 years, forcing policymakers to essentially fly blind.
Hard to wrap your head around operating like that for so long. And yet, look at equities. They're not reacting with fear, are they? U.S. futures, Dow, S&P, NASDAQ, they're all marching higher.
And this is where we see that disconnect, right? The market is prioritizing the short-term momentum, the corporate results, over these longer-term structural risks.
So it's an emotional response, like the fear and greed index.
Exactly. If we look at that index, which tries to gauge market emotion, is it rational fear or, herd-driven greed? It's moving decisively away from fear. Some key indicators within it are suggesting maximum greed.
And that's supported by?
Mostly by stellar corporate earnings, it seems. That's providing the fuel for this risk appetite.
Okay, here's where it gets really interesting, because that market euphoria is running smack into some pretty serious geopolitics.
Let's pivot to trade volatility. First up, that confirmed Trump-E meeting.
Yeah, the confirmation they'll meet next Thursday on the sidelines of the APEC summit. That definitely brought some relief, especially to Asian stocks. Just knowing dialogue is still possible.
It's on the table.
Oh, the agenda's huge. Tariffs, obviously. But also rare earths, export controls, Taiwan. It's comprehensive.
Okay, so relief from the meeting happening. but are we maybe reading too much into just, well, extending the current situation? The source material hints that 155% tariff threat might be more strategic than just a deadline.
I think that's fair. The running assumption, sort of the base case expectation, is that they basically just kick the can down the road, extend the current trade truce, which expires November 10th.
Because the alternative is massive. Trump's threatened to ramp up tariffs on China to 155% starting November 1st if there's no deal or extension. So this meeting isn't really about solving the deep differences. It's probably more about avoiding that catastrophic escalation.
And that tension feeds right into China's big strategy, right? Their recent plenum confirmed tech self-sufficiency, AI, aviation as a top priority.
Precisely. That's the long game for them. But the U.S. still holds a key card, what the sources are calling the lithography choke point.
The specialized chip-making equipment.
Exactly. Highly complex stuff needed for advanced semiconductors. An analysis suggests U.S. export controls have inflicted, quote, significant damage on China's tech progress.
But there's a flip side.
Well, yeah, the double-edged sword is that this pressure, this pain, has also seemingly accelerated China's push for independence. It's forcing them to build out their own domestic supply chain faster.
Okay, speaking of escalation, let's talk about Canada. That spat seemed to come out of nowhere. Bizarre, almost.
It was remarkable, yeah. Just the sudden aggression, Trump announcing the immediate termination of all trade talks with Canada.
And the reason cited? An ad.
Apparently, yes. An advertisement funded by the Ontario provincial government. It used clips from a Ronald Reagan speech criticizing tariffs. Trump publicly called it illegal interference.
That feels disproportionate. What's the underlying instability for the market here, beyond the political drama?
Well, the sources connect this directly to the U.S. Supreme Court. The timing is key. The court's scheduled to hear arguments on November 5th about the constitutionality of his tariffs.
Okay, so the thinking is...
His reaction strongly suggests he's worried about losing that executive power to impose tariffs unilaterally. So this Canada spat could be him sending a really clear, maybe aggressive message about political interference right before those crucial arguments.
Which creates immediate uncertainty for
key U.S.-Canada supply chains. Absolutely, it's a serious potential disruption.
Yet, despite all this, the China tension, the Canada issue U.S. equities seem pretty resilient. Intel feels like a prime example. Corporate strength winning out.
Absolutely. Intel's a great case study. Shares are up, almost 90% year to date, mostly on an upbeat forecast. Signs their comeback plan is working, even though the foundry part is still losing money.
So strong earnings can paper over geopolitical cracks for now.
It seems so. That kind of strength from a major player provides a crucial offset to the geopolitical noise. And it has a positive read-through for others in the chain, like European suppliers, think ASML.
Okay, let's use that to pivot then to the global currency picture, the FX side, and what's happening in Europe macro-wise.
Yeah.
Particularly that euro-yen dynamic.
Right. Starting over in Japan, their core CPI for September came in at 2.9%, bang on target with estimates.
Inflation's there,
But the Bank of Japan, the BOJ, is still widely expected to just hold rates steady. January 2026 still looks like the most likely window for any actual hike.
What are they worried about?
BOJ officials seem really sensitive to volatility in the JGB market, Japanese government bonds. We saw the yen strengthen a bit against the dollar. USD JPY dipped after the US CPI miss.
Right, down towards 152.3 briefly.
Yeah, but the sources suggest any big BOJ intervention or policy shift probably only happens if that pair really starts pushing up towards the 155 level. That seems to be the line in the sand for now.
Okay, shifting to the Eurozone. We talked about fracture. The overall Eurozone composite PMI for October actually looks surprisingly strong, 52.2, defying stagnation fears.
Yeah, on the surface, but it's really an illusion of strength. If you look under the hood, it's almost entirely German momentum driving that number.
Germany's PMI
Surged. Composite hit 53.8, its highest since May 2023, driven mostly by a really robust services sector there.
So what's creating that massive divergence then? If Germany's surging, who's dragging?
It's France. France's composite PMI fell again, down to a pretty dismal 46.8. That marks, I think, its 14th consecutive decline.
14 declines. Wow, what's driving that weakness?
It seems directly tied to internal political turmoil. President Macron is facing headwinds, high budget deficits, resistance to fiscal reforms, plus ongoing budget stress generally. It's really dragging down the whole bloc's average.
Okay, so boil it down for us. What does this German strength versus French weakness mean for the euro itself? Especially with that unresolved issue of frozen Russian assets still hanging around.
Well, this is really the critical structural insight for the euro, I think. You've got Germany showing clear signs of a solid recovery, which is positive. But the euro area's overall growth is fundamentally hobbled by that French fiscal strain and the political uncertainty there.
And the Russian assets complicate things further.
They do. The slow progress on figuring out how to handle those frozen assets, countries like Belgium wanting assurances they won't be left holding the bag liability-wise, it just undermines confidence in the whole bloc's structural cohesion. It adds another layer of uncertainty for the currency.
So what does this all mean? It feels like the core challenge for us watching all this volatility is pretty simple, maybe deceptively so. The market's riding high right now, CPI relief, tech earnings.
Right.
But it seems to be aggressively ignoring some pretty serious structural fault lines.
Yeah.
CPI bought the Fed time, sure, but that clock is ticking on data integrity.
Definitely.
U.S. equities look resilient, but the trade instability is acute. That 155% tariff threat hasn't gone away. And Europe, well, it looks fundamentally fractured. German strength can't entirely mask French fiscal weakness.
That's a good framework. And it helps us look ahead, too. As we check the upcoming economic schedule on investing.com, later today we've got more European PMI data coming, plus the University of Michigan sentiment survey. The key question we're left mulling over is this. Can European political stability, and particularly that German economic momentum we're seeing, can it really withstand the persistent fiscal pressure coming out of France? And on top of that, the high-stakes U.S.-China trade fight, which is obviously very, very far from being resolved, that's the real stress test coming up.